Okay, so thanks for attending today's webinar. It's the last one for this year that we'll be doing from IG, as an IG analyst. So really we'll be looking at some of the things moving into 2018 because right now we are in the middle of December and it's quite an interesting month as well so far. And it's probably only going to heat up into the new year. And so if you have any questions, once again, I'll really appreciate you can ask me. I really like this to be as interactive as I can. And I think my role here is really to sense the market for you and give you some of the views in terms of how medium to longer term views and how to watch for some of the levels. So today we'll go through that. As per usual, before I start, we will have to go through the disclaimers. So I know some of you are familiar with this. Once again, the information prepared today is intended for general circulation. It does not take into account your specific investment objectives, financial situation, particular needs. So have a read of this. And we'll move on from here. So, well, we always do this at the start of the month, but right now we're kind of in the middle of December, where we just go back through the key events that we've seen in November. So there was the Fed FOMC meeting. We had the Bank of England first rate hike since in a decade, and we did see that the market was really expecting that and saw this sell the news phenomenon carrying through, which actually sent the pound declining. And then moving on, by 3rd November, we've suddenly heard Federal Reserve Chair Janet Yellen's successor, Jerome Powell, taking over. And so far, we have seen that there's really been the continuity plan that has been in place for the markets based on the latest Fed meeting and a couple of other events. I think what we've seen as well from the Fed minutes through their 31st October to 1st November meeting have been the fact that the market still realized that they're very concerned about inflation. Certainly not very much change in the latest meeting, as well as their statement did highlight that close scrutiny of inflation figures, but that was when we see the dollar decline. And of course, the 30th of November, Thursday, OPEC meeting, where we did hear from OPEC and Co that they're going to extend the current output curve through to the end of through to the end of 2018. So I think for the markets, certainly that's been a positive sign. I've seen prices being supported at this moment. I'll give you some of the views on how oil prices might carry forth through to 2018 towards the end of the section today as well. And then moving on to December, I think it's been quite an interesting month. I mean, certainly today, this morning, many of you must have seen what has happened with the Fed's reaction as well towards the Fed meeting. So I think that had probably been the most interesting event thus far. Market was expecting that rate hike that came through, and of course the market reacted in a very disappointing manner of a disappointment, given that I think there were some expectations for the Fed to actually increase the number of rate hikes that they are anticipating for the new year. I'll show you that dot plot later as well. ECB Bank of England meeting, that's going to be today, so I'm not going to drag this for too long. Bank of England's decision come through at 8, ECB at 8:45 Singapore time, both of which are not expected to change rates, as certainly not the case, but what they have to provide into some kind of outlook will really be what's interesting. I think as much as possible, these might really be non-events, but it could also surprise. And then Eurozone Summit and also the Bank of Japan meeting towards the end of the month. So coming to this point, I thought it would be just good to quickly recap what we have seen for this year. It's been a very phenomenal year. Singapore Straits Times Index, those who trade it, certainly have seen that 20% year-to-date gain. So let's take a look. So these are some of the most traded assets classes in IG, and just highlighting some of the moves. This was taken at the start of December, and as you can see here, I would just want to highlight these few items. I think what I really want to point out is the fact that risk assets actually did outperform this year, especially for equities. You can see that all the red color bars are to the right of this chart, highlighting the fact that we have quite a good year, a lot of risk-taking behavior. I'm just going to show you a chart in a second, but also want to highlight the fact that, at the end of 2016, we were certainly expecting the Fed's 3 to 4 rate hikes to bring the dollar higher, but so far it's been declining, and certainly into the new year, I think generally that's the sentiment for it to continue as well. And I'll just delve a little bit into that the reasons over there. Once again, stop me anytime if you have any questions. Yeah, and for WTI futures, which is one of the US crude that if you can see on the IG platform, there are quite a lot of these upsides we have seen as well this year, which bodes pretty well for energy sector. Yeah, so as I've spoken earlier, there's a lot of risk-taking activities this year. You can see the equities has very much outperformed bonds. I mean, of course, with those clients with trading IG, mostly you just see equities over here, and of course the outperformance. I think that's one thing that we'll delve into later on, whether we continue into the next new year. So moving on over here, 2018 outlook. I think I'm just going to go through some of the key themes that we are expecting for 2018 in the market. I think it's quite important, especially when you do conduct your trading in the short-term basis. You will want to have at least an idea into what the market is expecting in the longer term when you are formulating your short-term trades as well. So we moving on. Once again, do stop me if you have any questions. Yeah. So for 2018, I think really what forms a big part of how markets might perform, equity markets specifically, and also currency markets as well, is how growth might actually pan out into the new year and into 2018. This chart here, which I've gotten from the last update from the International Monetary Fund, IMF, is that growth certainly is expected to continue rising. If you look at a lot of the research houses, they are suggesting the same thing. So on the chart here, you can see that on the left side, world GDP is expected to continue. IMF sees it at 3.6% by the end of 2017 and up to 3.8% next year. But this growth certainly is expected to be rather uneven. So US and emerging markets might actually see this broad improvement continuing. However, for the likes of the Euro area, UK, and closer to home, China, they might be joining the shorter end of the stick and actually see their growth actually moderating into 2018. And we'll talk a little bit about the impact. And for those who might want to have a look at some of the specific numbers, here you go. So 2017, some of the consensus versus what Goldman has to offer. Here we have a look over here, and you might want to just grab a screenshot as well. Yes, so moving on for 2018, things to watch that could really affect how markets might perform. I picked out these few items quite specifically. So growth trajectory, whether it really pans out as how we are expecting them at this point of time. In terms of central bank tightening, how that might affect the rest of the world. And of course, inflation trend, the very elusive inflation figures. And last but not least, in very broad strokes, the fact that there's geopolitical risk this year has plagued the market, especially from North Korea and some bits in US politics, Brexit lingering concern as well. So how that might actually play a part next year, I think certainly we have to keep an eye out for that as well. So First and foremost, I just want to highlight growth trajectory. We just covered that shortly. It's expected to broadly improve, but unevenness spreading across the different economies. So moving on from there, monetary policy. I just want to bring this table to you. It shows the private forecasters' view, which I have retrieved from the Bloomberg consensus, and you can see that on the broad overview, central banks themselves are expected to actually show a little bit of tightening for the likes of the US and rather removal of accommodation in some of the rest, including the ECB, and that itself might actually bring a little bit of volatility to equity markets, in my opinion. So on a broad level, you can see that monetary policy is still regarded as accommodative but less so into 2018. Let's start with the first. Federal Reserve expected to see about by the end of 2018 a little bit of the increase in terms of their interest rate hikes. I'll show you the dot plot later as well. There are more hawkish members expected to join into the voting committee over there. So I think how that might pan out for 2018 is going to be quite interesting and certainly keeps central banks very relevant in terms of how they might impact the market. ECB and the Bank of Japan, both of which are unlikely going to raise their rates, but both expected to see their balance sheet perhaps expand at a slower pace. UK expecting more hikes into 2018, but this is really as subjective to their growth situation, and also keeping an eye on Brexit development into their 2019 deadline for the talks. So right now they're moving on to trade aspects. It's really quite important as well. And last but not least, for the RBA, the Reserve Bank of Australia, I think we generally see the growth expected to improve, but how inflation might pick up remains a question as well. So next thing we want to talk about is probably inflation, and if you look at the table below, you can see that inflation generally is expected to pick up. This I've taken from Morgan Stanley research. It's quite a good graphical representation of whether inflation is expected to increase, and if you look on top, there's a little bit more comprehensive, taking the numbers from a lot of analysts, economists, and that into 2018. Certainly that expectation, and I have to highlight is the fact that this is an expectation for inflation, is to continue picking up, but in terms of whether it could really be the case, I think it remains subjective at this moment. And also the fact that we have geopolitical risk. So I think we have seen quite a number of interesting elections in the past last year, and I think that itself remains something to be of concern. If you look at this table here, we have quite a number. What really probably matters to us will be the US midterm election into the end of the year in November, so certainly want to keep within your radar as well, whether that, we have had Alabama mid-election that came through, and we saw the Republicans managing to lose one seat in the Senate. A little bit of this concern over there, how that might pan out. I think this is actually an opportunity, one side actually read that this is a people's opportunity to express their satisfaction or frustration with the president's performance. So whether we're going to get the reflection of the sentiment at that point of time might actually introduce a little bit of volatility. So really this is something all on a very broad, longer term, but for the very near term, I'm just going to move on to a few items to start you right off the year. So the three themes to look out for in 2018, in my opinion, first and foremost, dollar trajectory. And second, whether it's going to continue to be a good year for equities, and last but not least, in terms of the commodities view, I'm just going to touch a little bit on oil and short comment on Bitcoin as well. Yeah, so moving on here, I think this chart might be one that's quite interesting to clients. Perhaps just have a look. I think this is the FX forecast taken as of yesterday for the major pairs. I think market, I think just want to highlight the fact that if you look at the first row dollar index, which is the US dollar measured against six major currency, the six major currencies, is that the expectation continues to be one for the dollar index to continue falling through to throughout the whole of 2018. So I think this is something that we want to explore a little bit further and to see really that is that the case to be seen. Dollar yen here expected to actually show a little bit of upsides, and this is despite the fact that the dollar index is supposed to decline. We'll delve a little bit into why that could be the case and what to watch out for, some of the levels, and of course for the local Sing market, quite an interesting dimension as well. You see dollar Sing expected to actually pick up in the first quarter, but before that, following which is going to actually steadily decline. I do not really have a chart for that, but I think what is worth watching is the fact that in the first quarter we might see tax reform coming through into play before the fact that the MAS is expected to actually shift the slope of the year. I think economists are a little bit mixed in terms of how much that shift could actually be the case. So certainly want to monitor into April period, and then how that might actually pan out for dollar Sing as well. Sing could actually strengthen in that case. So there we go with that expectation that we are seeing. So back once again to the US dollar. So touching a little bit on the US dollar, I think we have to talk about the US tax overhaul. Before today, this was where the US House and Senate had to actually reconciliate. I've circled out the fact that corporate tax is expected to be 20%. It's no longer the case. House and Senate had actually negotiated and agreed on Wednesday on the final version for the bill that itself sees the corporate rate at 21%. So I think this is something that's very important for the US dollar, even with the longer term view that the dollar index, or at least dollar against most of the major currencies, is expected to fall. I think with what we have with the tax, that could actually bring up the dollar index in the first quarter of the year, especially with the US front loading a lot of these tax cuts. So the full details is expected to be released later this week, which really leaves us with Friday and the US session as well. But the full House and Senate are expected to really vote on this next week. So it's going to be quite a big week next week, and especially before Christmas, is one of their priority to see this pass. So I'm just going to touch a little bit on that when I talk about the levels in just a minute. But for now, I just want to go through the dot plot as well. So we know that the Federal Reserve had actually met this week, their decision coming through and keeping their 2018 projection for rate hikes at 3 rate hikes. The market, if you look at the pricing based on the Fed Fund futures, the white line over here is only giving that confidence of 2 rate hikes. So how is that going to pan out in the longer term for the market? I think really, I think the market right now, it's on one hand, for the short term, they are very apprehensive with regards to whether we're going to see that full 3 rate hikes being implemented. And even so, I think that some of the analysts I've spoken to actually did express the fact that given the longer term interest rate hikes, the fact that should we actually see these hawkish new members coming through, front loading some of these rate hikes, we might see lesser rate hikes moving into the even 2019. So therefore, the market has really been selling the dollar on this expectation. So generally, the bias over here is really towards the downside for the dollar in the whole year. But having said that, just moving into the how the market might perform, I think it will be quite interesting to look at the dynamics for the US dollar index. Really one, I think, that captures a lot of the moves here. So let me just bring out the chart. Yeah, so I think if you have a look over here, what we have for those trading the US dollar basket, we can see that prices have been hanging literally in this range of late. On the low end, we have around the support at 92 spot 50 levels, and on the upside, 94 has been seeing a little bit of this capping the pressure on capping the prices on the upside. So in my opinion, given what we have with the tax reform really getting into quite good momentum here, and whether we're going to get the vote next week, it might really be on the positive end. That could really bring up the dollar index up to test the 94 level, and eyeing that upside to the longer term downtrend, which really dates back to the early part of this year, so around 95 into the year. And I think that's something that we can certainly keep into mind. So with that break around 94, do I upside to 95 levels, but should having said that, on the longer term as well, you can see that this sort of like a head and shoulder pattern forming, and that could really see that pressure on the lower end in the longer term. So keep this trade in mind and something to really look out for. And then moving on from here, yeah, so I think quite interestingly, I think a lot of the market really do focus on how having a look at, considering seasonality as well. I think what we're seeing in December with a lot of this repatriation is that seasonally it's been a strong month, and with that certainly supports our view as well in terms of how tax reform should it actually be passed actually help to bring in as well. And then moving on to January, it's been rather of a mixed month, but should we really do get the tax reform passing, that's going to help us see dollar clinching on to gains. So when we talk about the US dollar, I think it's really quite important that we don't miss out on gold prices as well. I think so far in the year, gold prices has been one that is range bound, and certainly one that reflects that risk sentiment playing across the market. I think in terms of how that might translate the dollar index movement and expectation translate to gold prices performance is that you can see that gold prices has generally been on an uptrend, but so far it's been sleeping as the dollar gains a bit of strength of late, whether it's in terms of the tax reform confidence or the fact that inflation itself has been showing a little bit of improvement, even though it did miss expectations for the latest release in the US, but generally it's been picking a little bit up since September. So on that note, I do think that the gold prices itself might actually see a little bit of pressure down to the earlier support level around 1220 before that support kicks in, and we see that, with the dollar decline that we have mentioned earlier on the longer term outlook, might bring gold prices up higher in the longer term into 2018. I do see that the bias remains on the upside for gold prices over the longer term. So moving on from here, I think in terms of when we talk about currency market, just now I just highlighted to everyone that even though dollar index is expected to slip, dollar yen actually the market is actually penning slight upsides for dollar yen. And why is this so? I think dollar yen itself has been an interesting one. So if you look at many of the Asian currencies, it's really mirroring what we have, the dollar index sliding all the way since the start of this year, and finding a little bit of support of late. But for dollar yen, it's really wobbling, doing these oscillating moves between around 108.50 towards 114 spot 50 level. So it's showing that oscillation really since February. And I think the question is, are we going to see prices move out strongly, and should that break actually come true, I think it will really be one of the good opportunities to trade this pair, and how that might actually play out I would think that the bias is on the upside. And why is that so? So this might be a little bit of a squiggly chart where we have a lot of things going on, but just hear me on when I explain this. So in terms of how dollar yen has moved through the year, I do think that that's really due to the fact of the difference between the longer term yield. So we do know that the Bank of Japan has kept 10-year yields really close to 0%, whereas the Federal Reserve has seen largely their yields moving according to the market sentiment and also the interest rate expectations. Yield curve flattening itself has placed a little bit of pressure, so there's been closing the gap between the two on 10-year yields, and therefore we're seeing prices itself moving accordingly of late. But how things might pan out in the longer term, so I think given the situation right now, I think the quantitative tightening in the US, especially we know that the Fed has entered that phase itself, might really see the US bond yields pick up on the longer end into the new year. Of course, I think that the market is not really pricing in this at this moment. It's a lot of uncertainty and it's not a lot of clarity with regards to quantitative tightening. But as we move into the new year, I think as the Fed move further along into reducing their balance sheet, we can really see that US bond yields might actually pick up. And in this case, between the US Treasuries and JGBs, I think that's going to be when we see the spread actually widening, and therefore with that being the case, a lot of this demand in the yields will go towards the US, and in turn actually see dollar yen bids coming through, and that falls in line with what the analysts are forecasting in the chart that I have shown you earlier. So that really explains my view that dollar yen could really see further upsides into the new year. So really watch out on that one over there, and of course in the short term that bias as well on the upside given the rosy growth conditions, and also the fact that tax reform in the US seems to be one that is coming through. Yeah. So, but I would have to say one word of warning, of course, there are slight expectations that Japan might be on the less accommodating end and actually lift their yield curve control on the long end by slightly, but I don't think that this is going to catch up with the move that the Fed might see, so the US might see, so therefore still holding on to my view here. And I think with that we round up a little bit on the FX movements. If anyone have any questions, please feel free to post them to me. Now just take a 5-second pause over here. Yeah, so moving on a little bit to indices, I think it's going to be quite a while ride, I think, into next year. We have had a good year. If you're trading a lot of the Asian markets, you are seeing the likes of Singapore Straits Times Index with year-to-date gains of 19.27% when last checked. You have the Hang Seng Index up 32%, really impressive, outdoing that of the S&P 500 at 19% and Dow Jones at 24%. So moving on to next year, are we going to continue seeing this? Definitely the answer, if you cut across, is unlikely. But should there be caution ahead? I think that's really an interesting theme as well. So in terms of what we are seeing with equity indices right now, you can see that a lot of warning signs. People are a little bit apprehensive, and yet there's one's saying do not go against the trend. So moving to 2018, should there be caution ahead? I think there's two themes that to look out for. One, whether there's in terms of the reduction in accommodation. As I've mentioned earlier, a lot of this tightening and removal of accommodation in advanced economies that could actually bring in some volatility for the markets, and also some of these views that valuations are stretched, but a lot of markets really ignoring that. So whether would that actually play into the picture as well, something to keep in mind when there actually is a downturn. So just throwing in this chart, I think if you just look around the web, you can get a lot of these charts telling you how long it's been. So this chart here, as of November 17, 2017, we can see that the number of days since a 5% drawdown on the S&P 500 index have been 353, and I definitely think that number has increased as of today. I think markets really saying that this trend has been the case and it's long overdue for a drawdown, but are we really going to see a steep downturn? As I've mentioned earlier, I think growth itself is going to be quite a key fundamental factor in business confidence been improving. Trade is pretty much steady and rosy. So I think that itself might not actually deliver us that huge disappointment. And as we are still embarking on that increase, embarking on that increase in terms of the growth figures across, and embarking on that business cycle, recovery cycle here. I think that's going to see 2018 still having upsides. And for the likes of the S&P 500, the first quarter, there's expectation for the tax reform to pass and the front loading of things. The tax cuts could really bring the market continuing on an uptrend. In terms of how that might pan out for the markets over here, we're certainly seeing the S&P 500 index at all-time high. So it's really hard to call on the upside, but when you do draw out these lines as well, which I encourage you to do as well if you're trading this US market, do look out for any cross of some of this resistance, whether in terms of the uptrend channel support or the horizontal resistance. I think that's when you really have to put in that caution and see if there's any reversal in trend. MACD here does suggest that we are continuing seeing the upsides, and with the tax reform hopes, I don't think this might see a pause anytime in the first quarter. But I think moving on to the new year as well, we are going to provide a lot more frequent updates. So do hope you tune into that, and we'll just really update you anytime there's going to be some changes. And as well into as in the seasonal effect, just want to have a look as well. I think what we have with December last year wasn't exactly the most rosy situation, but it could all change in this year, as we do find that the market so last year we did see the market itself going on that Trump rally, and it's one of the longest so far. So in terms of how things might pan out in December, I think it hinges a lot on what the tax reform has to say. And into January, are we going to find the January effect, which is when market really power into the buying? I think that itself really once again supported by the tax reform anticipation. So do keep a close eye for that. Dow Jones likewise showing that same trend in terms of seasonal factors as well. So at this point of time, I think it might be quite interesting to bring in a little bit on the Asian equities and of things. I think investors here are a lot more familiar with that. So over here, there is really the two counteracting forces. On one hand, we are seeing that valuations are high for Asian ex-Japan market. This chart taken from HSBC's research, but on the other hand, markets are similarly still rather resilient. So that strong earnings upgrades that we have had has been keeping investors invested. And of course, with the fact that dollar itself is still expected to continue on the slide, I think that's going to support the market. But amongst all that we have seen, which one will probably be one to capture a lot of these gains moving into 2018? I think I'm going to stick my bid sustaining with the local Singapore market. So I think we've seen quite an interesting movement with respect to the Singapore market. I'm just going to bring out the chart in a moment. Finding a little bit of technical difficulties in terms of opening my chart right now. I'm just going to speak about it over here on this chart that I managed to update just earlier today. So if you look at the chart over here, we've seen Singapore markets stalling slightly in the third quarter. Geopolitical concerns being one of it to impact our Singapore here. And over and above that, the fact that the US did see the interest rate pick up, actually saw the dollar itself sliding, the dollar itself picking up, that's been placing pressure for Asian markets. But in terms of how things might pan out into 2018, given how Singapore is one that's really exposed to factors overseas, I think that's going to give us quite a head start in terms of capturing many of these global growth improvements. And if you do look at the trend here, which having a little bit of technical difficulties to show you on longer term, but the general market consensus is that we're going to continue seeing some upsides to the 3,600 to the 3,700 region into the end of the year, but very cautious increase, because given the year we might really see a lot of turbulence in between due to the fact that we have the quantitative tightening in the US that might bring about a little bit of turbulence here for Asian markets, which really fall into part of the riskier assets. Yeah. And I think a lot of people will be asking a little on the Hong Kong market as well. The Hang Seng HS50, it's really the best year-to-date performer as of the latest tally. You can see that the increase at 32% year-to-date increase is really quite impressive. But in terms of how things might pan out, I think this is one market that's been one to come under quite a bit of attack during the profit taking, so I really wouldn't be recommending this. And in fact, if I do see a reversal, I think this will be one to capture the downward momentum in quite a strong manner. So really contrasting the Singapore and the Hong Kong markets for you over here. And just a quick one on commodities as well. I think I'm not sure if many people here are trading crude prices, crude oil as well. We can certainly see that crude market has been quite an interesting one, really jumping up since into August period, and prices can be seen really elevated as of yet. This was taken just a short while this afternoon. So in terms of how the view of the crude oil market will be into 2018, I think generally the market has this view that crude oil prices may remain rather not too different from the current levels, but maybe a slight decline, especially for the likes of WTI futures to about slightly to just above $55, and for that of the Brent down to about $61 per barrel. And why is this so? So I think what with the OPEC managing to extend that, with the OPEC managing to extend their 9 months of their curb through to the end of 2018, they have really managed to remove one of the big events, big downside risk in the near term. But having said this, there's some concerns with regards to how the US output may have performed. So if you look at the orange line over here, which actually is the Baker Hughes oil rig count, so it's increased about 200 counts to the latest 747 as of last week. And I think that trend may really continue with the price being so elevated at this moment. And of course, this week we have also heard from the US Department of Energy and also OPEC highlighting to the markets that they have that view that the production in the US and in OPEC, since they are expecting other non-OPEC producers to also actually increase the output into 2018. So I think that's going to put some pressure into markets, and therefore certainly exposing the crude prices to the downside. So I would think that really it's quite an interesting one to trade, especially according to the US reports of late that build up in terms of crude inventories been affecting the prices over here. So to look out for that. I think this US crude market that we're showing here, you can see that resistance around $58.96 have been really one capping prices on the upside, and I do not see it being able to break it in a strong manner. So do have a look over here. And just a short note on Bitcoin, I think the market's been really paying quite a bit of attention to how Bitcoin is performing. A lot of views that prices may continue going up, and then on the flip side of things, you have investors, you have analysts also warning of how this thing might not be able to be valued, and therefore it's caution ahead. I think generally the view at this moment is that really indeed it's very hard to put a finger to it. We have quite a lot of this trend trading going on. You can see that if I put like a support across, cutting across the longer term region over here, it's really getting steeper and steeper as we talk about it. So in terms of how that could really pan out in terms of how technical, and I do think that technical analysis plays quite a strong part over here, and anytime we might actually see a reversal cutting across these support lines, I think it's going to be one to really watch out for whether the market react in a big manner. So really on the upsides, I really would be on the cautious end here. I would rather choose to err on the cautious end, and on reversal, I think that's when the market could really step in a big way. So really do keep a lookout for this, and think this pretty much round off my webinar for today. And if there is any question, please shoot them out to me and I'll be happy to take them. But before then, just to highlight that if you would prefer some of the more near-term updates, you can head on to my Twitter and follow some of the updates that I might provide with regards to any breaking news or movements in the market. And once again, post any questions that you might have to me, and if not, my next market update is going to be on the 11th of January. It's going to be Thursday at the same time, this Thursday same time. So yeah, thanks so much for being here to listen today. And just a quick update as well. I think just a little bit outlook into the new year. I'm going to conduct more short snippets on a weekly basis, and I think that's going to be a lot more relevant. The plan is to put this around 9 a.m. just before the day starts, and you can get a look into some of the views that we have for the markets and where are some of the opportunities given the overnight lead. So 9 a.m. if you do think that have any feedback, you can send it to our email IG education@ig.com. So appreciate you being here today, and happy trading. We have the Bank of England and ECB coming up for those trading the FX market.